finances, its ability to spend, coupled with more measures that can possibly be taken from a policy and administrative standpoint to curtail inflation. And when you throw in the central bank's monetary policy into the mix, there's clearly a lot that needs to be unpacked. Joining me to give you a little bit of perspective at this point is Siddhartha Sanyal, the Chief Economist and Head Research at Bandhan Bank. Thank you so much, Siddhartha, for taking the time. Now, there were several headlines in that annual report that the Reserve Bank of India sent out today, but two items stood out to me. One, of course, was the transfer to the contingency fund, which perhaps explained the reduction of the surplus that was transferred to the government. And the second relates to the RBI's reading on inflation and the fact that it is subject to considerable uncertainty. On that first point, though, what's your reading of the RBI's balance sheet? The contingency risk buffer has been kept at 5.5%. How does this, what implications does this have for the government's finances?
Well, in a year like this, or in general, from the standpoint of a conservative central banker, it's not unexpected that they will be maintaining a healthy reserve. And all, I'll not talk specifically only about the contingency reserve alone. I think that particular position remains pretty significant. And at the same time, from a government finance point of, rather than trying to get quite a bit of additional surplus transferred to the government's balance sheet, government kitty to support the borrowing program or to reduce the quantum of borrowing is not the optimum scenario. Rather than that, it's much better to continue maintaining a prudent approach so far as central bank's balance sheet is concerned. And I think there is no debate on that. As regards to your other point about what is happening on the inflation front, growth front, I think you yourself summarized it very nicely, that while there is a very clear signal or possibility of some bit of additional slowdown in growth momentum, given the global situation, given the inflationary pressures, given the central bank actions worldwide, it's very, very difficult for any central bank at this moment, including the Reserve Bank of India, to ignore the inflationary pressures. And even if that means a bit of sacrifice of growth in the near term, they will remain conservative, and they will possibly go for some more tightening in the near term. So basically, staying conservative will remain the theme for the central bank in the near term amidst all this turmoil.
What is your own assessment and your own expectation about the next policy meeting? There is a large expectation that there will be some action on the policy rates. Are you also anticipating a hike?
That's a very logical expectation. If you see a central bank, in between policy meetings, if it comes for a off-cycle hike, and that too for a large 40 basis point hike, it becomes almost a very strong expectation then that 4 weeks later, when the policy comes, the scheduled policy date comes, there will be some bit of a hike. So that hike can also be something anywhere in the range of 25 to 40 basis points. That means if I take somewhere in the middle part of this particular zone, what it means is that in this particular quarter, in that case, if I assume 35 basis points, the central bank will end up delivering a 75 basis point of cumulative repo rate hike alone, leave aside the CRR hike. Now here this is a very interesting scenario, that in the beginning of April, generally the expectation was that we are close to the start of the rate hike cycle, and in this particular quarter there was a possibility of a rate hike, but nobody was really anticipating anything more than a 25 basis point hike in this particular quarter. Now it looks like during the quarter, instead of that 25, which we were expecting just a few weeks back, it can eventually be as large as 75 basis points.
But Siddharth, I was speaking to a bond market participant earlier today, and what he was saying was that the baseline projection or expectation now is that there could be a repo rate of at least 5.5% by the end of FY23, if not more than that over the course of the next 18 months. Is that something that we can anticipate?
somewhere above the 5% zone is quite likely over the course of the, say, next close to 12 months. Now, whether it remains slightly lower in the 5% handle or 5.5 or potentially even higher, that will depend on a number of factors. At the moment, inflationary pressures are very high. But at the same time, the growth numbers, growth momentum will also be coming down, or we'll see some bit of loss in growth momentum. For example, the number which is due in 3-4 days time, it's not really expected to be a very strong number. Now, if it so happens that inflationary upticks come to some kind of see some kind of a slowdown, and growth numbers indeed as expected will turn a little somber, and central bank by the time has already possibly front loaded a lot of their hikes, then they might actually take a review of the situation possibly in the early second half of the financial year, and take stock at that point of time. But if someone says 5.5, it's not something unheard of in this kind of a scenario over the course of the next 12 months.
Fair enough. Which brings me to the next point. You mentioned that there is a significant possibility of a soft growth number, not just in the fourth quarter, but in the annual report itself, the RBI is saying that your indicators are suggesting a loss of momentum, right? What are your own expectations on both the levers? You're of course, you're balancing inflation and growth, but you're talking about the possibility of CPI above 6% comfortably in FY23. What is the projection on both growth and inflation at this juncture?
Well, growth, if you see in the beginning of the financial year, the RBI started the year with something like a 7.2% kind of a number. Now, that numbers really looks optimistic at this moment, and the number can actually be somewhere in the zone of 6.5 to 7% kind of a zone over the course of the full financial year. Now, it might look like some bit of loss of growth compared to where we started the year with in terms of expectation. But my sense is that in the current global macro scenario, against the backdrop of current policy response from central bank and governments worldwide, even if it is a 6.5% number, it should be seen as a pretty healthy number, provided the composition is not too lopsided in favor of government spending or something of that sort. So anywhere between 6.5 to 7%, more like closer to 6.5% than 7 would be my guess, but I would not necessarily see it as a number overtly. I'd not be very pessimistic about the interpretation of that particular number.
You mentioned government spending, and among the levers of growth, that has been a prominent one in the recent past. It's expected to be going forward as well. Do you anticipate to a certain extent that lever will be constrained in a situation where bond yields trend higher? They have, of course, cooled off just a tad bit. But if the government's borrowing number is going to be larger than was previously anticipated, first of all, do you anticipate that? And second, do you think it will be constrained because it can't borrow?
This is actually a very interesting question, Alex. I put it this way, that the government's ability first of all, I'll take a step back. I'll possibly not straight away link it to the bond yield, and the thought process should not come from bond yield. It's kind of a resultant factor rather. But if I see that what is the overall fiscal situation and what is the overall growth inflation dynamics, it doesn't suggest that the government should spend big time over the course of this current financial year. Which was possibly the case in the previous 1 or 2 financial years, where growth was tanking very significantly and inflation was not really an imminent threat. But in this kind of a scenario, the central bank the government for their overall fiscal spending would have to be somewhat cautious. Now, having said that there are so many areas where there is a still need to provide some bit of support to maintain employment, to generate employment, to maintain the growth momentum. It's important that the government remains very prudent, wise, or even opportunistic at times to find out some small ticket areas of investment and spending, and spend in those areas which can actually try to provide support to possibly the lower end of the socioeconomic strata and provide some bit of support to the overall growth momentum. So the overall, so while the RBI cannot think of a very relaxed policy, while the government cannot think of an overall very profligatory fiscal policy, but they have to find out pockets, they have to possibly figure out innovative tools to provide supports in some of the pockets.
Talking earlier in the day, Siddharth, about some of the measures that were taken by the government to curtail inflation. Can a parallel be drawn there? Certain pockets need to be targeted. The RBI themselves talk about more that can possibly be done on the fiscal side to curtail inflation further. What are the low-hanging fruit, according to you, that the government can target right now?
I think some of the areas, if you are referring to something like the excise duty cuts, well, a significant excise duty cut has been delivered right now. You cannot expect too many large excise duty cuts will be delivered very frequently or very quickly. But at the same time, there are some of the other areas, like in terms of managing imports and exports of certain commodities, depending on the commodity specific pressures, that needs to be adopted. We are talking about monetary tools, we are talking about fiscal tools. I think at the same breath, in this kind of a situation, we have to continuously discuss about administrative tools also. Administrative tools at the level of the central government, at the level of state governments, at the level of potentially even at the local level governments. They have to be quite vigilant in terms with their administrative tools to provide some bit of additional support in the overall mission of inflation fighting. And the other point of import-export control on certain commodities, I think the key is the response has to be strategic and swift. It's very, if you say that for this particular commodity we will be importing in over a certain period of time, still those prices do not cool off quickly. But if you actually surprise the market with some bit of very quick response in terms of import, say, of one particular commodity, then from a trading point of view also there remains some bit of surprise quotient, and it helps in terms of anchoring inflation expectation in case of some of the commodities going ahead in future months as well. So I think that has to be the approach, and there has to be a lot of out-of-box thinking, because straitjacket answers may not be adequate in this kind of a scenario.
Maybe perhaps to a certain extent, Siddharth, we can leave it in the hands of the gods, and hopefully the monsoons, which are just a couple of weeks away, will be